You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Welcome back, everyone, to yet another episode of the Young Investors Podcast. Hamish Hodder, what's going on, my friend?
Not a lot this week.
You've been watching the inauguration happening?
I actually haven't watched any of it yet. When was it yesterday? Was it overnight?
I think it was overnight. I think it started at like 3 o'clock in the morning this morning.
Okay. Yeah.
And it's now nighttime over in Washington. And so all of the formalities are over. And it's pretty crazy. Biden has immediately got to work, like working on on signing the executive orders and all that. It's like he doesn't even want his first day to just be celebrations. He's just like, all right, straight in, here we go.
Just start pumping out legislation, pumping out change.
It's almost like that, yeah. But that's interesting. From what I've caught up in the couple of hours that I've been awake this morning, nothing drastic happened like people were anticipating from the trumpets. Nothing seemed to happen. Seemed to be a fairly normal ceremony. You got sworn in. No one was there in the crowd. So there you go. Trump can say he didn't have the lowest inauguration crowd. I think Joe Biden will be proud that he had the lowest because it meant that everybody stayed home.
That is true. Yeah, it's such a different. It's so weird how there's so many different things that are different because of the pandemic.
Yeah,
it's crazy.
Yeah, absolutely bizarre.
Anyway,
but yeah, so that's been going on. We might have a bit more of a chat about that in a second. We should probably get started though.
Yes.
with the pod. What else have we got to talk about today? We've got a couple of things.
Yeah.
Netflix earnings, BlackRock, which the company behind the iShares ETFs, are now dabbling into Bitcoin, which is a little bit interesting for some of their funds. What else do we have? Bumble. Have you ever used Bumble? No, me neither. I've never had a need to. But the Bumble is getting an IPO. And a couple of things about Facebook and Jack Ma. Jack Ma's back, baby.
He's back.
He's back. He's come back from the dead. Oh, dear. So that'll be interesting. Anyway, let's get stuck into it.
Yeah. So today's episode is sponsored by ShareSite. New sponsor for today. First time you might be hearing about it.
Sponsor.
Got to freshen it up somehow. People are tuning out of it at this point. We need to spice it up. ShareSite, the greatest thing ever. Maybe halfway through the promotion, we will say what stocks we're buying this week. Okay. All right.
Except the problem is that we're not buying any stocks. All right. Anyway, all right. I guess it's the normal sponsored segment. Oh well.
Yeah. Anyway, so ShareSite, if you're not aware, is basically a piece of software that you can use to track the performance of your stock portfolio, and it will basically allow you to track all of the different types of gains. So capital gains, dividends, dividend reinvestment plans. It will do all of those calculations for you. If you have any of those, they're very common on ETFs and a number of businesses as well. So, and they're really hard to track manually. So being able to do all of that through ShareSite is a lifesaver. Currency gains, if you're buying shares internationally or you hold foreign currencies, this is huge. I did a portfolio review of my portfolio over the past year on my YouTube channel recently. And I think currency for some of the shares, I think one of them, Texas Roadhouse, it was negative 16% on the year. So basically, even if that stock had gone up 15%, the currency meant that my real return was zero. So if you're not tracking that, you might have thought, yay, I'm up 15%. But in reality, you could have been negative. So you need to be tracking currency. Super, super important. And again, it's basically impossible to do manually unless you're going to be entering in daily currency changes in a spreadsheet. I don't think so. But basically, on top of that, you can also use it at tax time to do a number of different calculations. So they produce a number of reports for you that can be used to figure out things such as your capital gains, dividend income, and more performance and that sort of thing. And basically, at the moment, you can try ShareSite for free by heading over to sharesite.com/young investors. That's site spelled SIGHT, sharesite.com/young investors. So use that link to sign up to a free plan and use it for as long as you want. And if you want more features, you can also use that link to sign up to a paid plan and get 4 months off a 12-month subscription. So go check it out if you're interested.
Indeed. All right. We should just finish off what we were talking about before with this inauguration stuff. So apparently, well, I saw on the TV just before, immediately Biden has just signed so many executive orders. You should have seen his desk. He had like 20 or 25 folders just stacked up on his desk. So I'm not sure I'm sure people will be reporting on it because I think it's happening like right now. But for the news report that I was watching, they showed him signing the first 3 executive orders and then they cut away. So from what I saw, the first one he signed was about compulsory mask wearing. And then he didn't really detail what each one was. He just kind of said, this one's about mask wearing. So he signed that one. And then the second one, I couldn't quite understand him, but I think he said it was, supporting underserved communities or something like that.
Right.
And he signed that one. And then the third one was rejoining the Paris Climate Accords. So back in the States straight away, they are back in, which is, that makes me very happy because that's an issue that I care about. It was also interesting. So Kamala Harris was swearing in the 3 new Democrats into the Senate. So we had John Ossoff, Raphael Warnock, who won the Georgia runoff elections. And then she was also swearing in Alex Padilla, who is the senator that is replacing Kamala Harris.
Right.
It was pretty funny. She I think I read a quote saying that after she swore in Alex, she was like saying to be replacing Senator from California, Kamala Harris. She was like, that was weird.
That is funny. So does that mean that they start in the Senate today, like the day that they're sworn in? Like in the same way, because remember we were talking about this last week. I mean, we still don't know. We probably should have done some research for you guys, but
I just don't know enough about American politics. But yeah, it seemed they're being sworn in today, so I guess this is the day where they're
effective.
in.
Yeah,
I would imagine so. But yeah, that's right. What we were talking about last week. Is there a period of time where they're not, even though they've been elected, they're not actually the senators yet, and that could have had implications on the Donald Trump Senate trial, impeachment trial. So, but I don't know. I imagine now that they've been sworn in, but then again, I'm not 100% sure.
Yeah,
sorry, I do not know everything there is to know about American politics.
I did tell you we'd have some expert commentary this week. There it was.
Expert commentary.
Brought to you by...
How do you like that? Just a dude that wants to talk about stock market investing saying, I don't know much about American politics. I thought we'd better cover it anyway. I mean, it's a pretty big deal. It's what everyone's been talking about this week. So that's basically all I've got.
Yeah. And I mean, the only thing I had to add was I was just reading an article before about some of the other changes that are expected to take place over the next few weeks. In fact, a couple of things that Biden was talking about on his Twitter page that were significant. One, of course, is this American Rescue Plan, which seems to be their sort of COVID plan that they're going to try and push through. And in it, he wants to do more stimulus, rent relief, food assistance, and aid to small businesses, among other things. So there's going to be a lot in this. And there's probably going to be a lot of changes that are happening over the next few months or the next few weeks. Another big one that he spoke about was a $15 minimum wage, which is something that a lot of people have been pushing for a very, very long time. So the fact that the Democrats now have control of the House and the Senate means that there's a very good chance that some of these Democratic policies that a lot of people have been arguing for or campaigning for, I should say, over the past, or for many years now, a lot of them will likely go through. So,
15, sorry, just to butt in, $15 minimum wage, I just did the maths, works out to $19.50 Australian.
Right. Yeah. So that's just about our minimum wage, right?
Yeah. About comparable, I would imagine.
What is our minimum wage? It's like $21.
I'm just going to look it up.
I think it's 21.
Australian. And it depends on how old you are too.
That's true. Yeah, we obviously have the lower minimum wage for younger people.
Yeah, $19.84 per hour is the current national minimum wage, according to fairwork.gov.au.
Okay.
So yeah, there you go. So yeah, it's basically the same. Same here as, it'll be the same in the States as what it is here.
Yeah, very interesting.
Yeah, sorry, I did interrupt you there.
No, that's pretty much all I had for that. The only other thing I saw was from the CBS article that I was reading is that they report that there's supposed to be, I think, 15 executive orders over the next couple of days or the next week. So there's a lot.
Well, I don't know. It looked like, from what I saw on that desk, it looked like there was about 15 folders there. I don't know if he's just doing them all as we speak right now, or whether that'll happen over the next few days. But yeah,
maybe he's just going to do them immediately. I mean, if they're already in folders, if they've already been,
yeah. I'm a bit tired, guys.
Yeah.
I'm going to do these other 12 tomorrow.
My wrist hurts. 3 per day.
I've signed my name too many times and now my fingers are sore. Oh, dear. Anyway, should we move on?
Yeah, definitely. All right.
Do you want to talk about Jack Ma?
Yeah, okay. We'll talk about
what's
Jack Ma.
going on here, because what's the story? He disappeared. He hasn't been seen publicly in months and months. He gave some speech, didn't he? And then there was a lot of backlash. And so he just kind of disappeared from the public eye for a little while, but he's back apparently.
Yeah. So the timeline of things that happened was there was basically his new company Ant Group, which their main product is Alipay. So it's a payment network that sort of came out of Alibaba. And that company was expected to go public on the Chinese markets. Right. And that was stopped by the Chinese government. And pretty much immediately after that, I think he was not seen for a really, really long period of time. He also gave that speech to talking about government stepping in to Alibaba.
Yeah, he spoke out, didn't he, against the government?
Yeah, and basically other large internet companies, because essentially what happened was President, I think I'm going to pronounce this wrong, but Xi Jinping. Xi Jinping. Basically, he said that the focus of this year would be to crack down on monopolistic internet companies. That's a quote. So that basically was a threat towards Alibaba in particular, which has obviously grown to massive success in China. But he was not seen for about 3 months. And I think we spoke about this at some point.
I think we did, a couple of weeks back.
Yeah, and a lot of people just believed that, well, there was a lot of speculation, obviously, but some people thought he might have been detained. Others thought that he might have left the country to avoid prosecution, that the Chinese government was coming after him. But none of that seems to have been true because he resurfaced this week. So
there you go.
The Jack Ma Foundation, which I presume is his charity, they released a statement saying that he participated in the online ceremony of the annual Rural Teacher Initiative event. It's a mouthful.
From his jail cell.
at gunpoint. On January 20th. So that was yesterday. So he and basically on top of that, there was a video that was released by the Global Times, which is just to be clear, it's a state affiliated media company in China. But they released a video of him discussing at this event. But the video made no mention to the rumors that he was missing or the situation with Alibaba and the Chinese government. So
maybe he just wants to disappear into the background.
Yeah.
I mean, fair enough. He's made enough money, hasn't he?
I mean, I think I said this on another podcast, but if you're missing for 3 months, or not missing, but if people are writing articles everywhere saying you're missing, surely you just tweet something.
Yeah, just say something.
So you just stick your hand up,
but
be
then
like,
again,
I'm fine.
Maybe he likes the intrigue. It's almost like a bit of gossip. Oh, what happened to Jack Ma? People start talking about you and then you're like, oh, I want to keep this going kind of thing. I don't know, something selfish like that. But apparently not. There you go. He's alive and may or may not be under Chinese surveillance. Well, isn't everyone under Chinese surveillance at this stage?
Well, yeah. I think Alibaba in particular is going to face some scrutiny this year, but what form that will take, Who knows? Could be.
That's so interesting. Just going back to his business that he started up was not allowed to go public. That sounds bizarre.
Yeah.
Especially if it's, like maybe, I don't know, if you're, I don't know, maybe if you were a United States intelligence business and you wanted to go public in China, maybe something like that might get blocked or something. But just like a Chinese built payment system gets blocked from going public, seems a bit bizarre to me.
Yeah, I'll be honest.
Was it just like the Chinese government just trying to flex on Jack Ma a little bit, saying no, we have the power over you? Or I don't really understand.
It could very well be that. I don't know the specifics of that particular story of it being blocked, but in China, in terms of payments, so in terms of payment processing, which is what Visa and MasterCard do, where they approve transactions between banks, all of that in China is done through the Chinese government. So the government approves every transaction, whereas Alipay is not a payment processor like Visa or MasterCard. It's more like PayPal, where it's like a digital wallet. So it kind of sidesteps that law in a way because people can transact payments through Alipay without having for that payment to be processed by the Chinese government, if that makes sense.
Right. I see.
That's also the case in Russia. They're the two. I believe they're the only two countries where payment processing from Visa or MasterCard are banned, where the government does all of it. So I'm not sure if that has anything to do with blocking it. Maybe it does, but that's the situation in China.
Man. It'd be so interesting going and like living in China for like 5 years and just learning about how different their processes are and what's the same to like how we do things here and what's different and how much of life is controlled by the state.
Yeah, I have no idea, honestly. It's not an area I've studied deeply. I'll be the first to admit that. And as you said, even if you had studied it deeply, it would be another thing to experience it firsthand. Very interesting.
Yeah, that's what I'd be interested in.
Yeah, I guess we'll probably have a lot of news coming out about Alibaba and government regulation probably over the course of the year. So we'll probably check back into this story to see what happens, whether Ant Group is able to IPO somewhere else or whether they eventually get allowed to IPO. We'll kind of see what happens.
Yeah, that's a good point you raised, because could they just IPO over in the States? Could they just take their business and go, all right, you don't want to allow us to, open IPO on our, local market. Let's head over to the States.
Maybe. Very well, maybe. Yeah.
I mean, there've been a fair few Chinese companies that have launched on the American market, right? So
that is true.
Who knows? All right, shall we move on into something else?
Yes. Where should
Let's talk about, this is interesting, BlackRock. I'm surprised by this. It says here BlackRock, so that's the company, the company behind iShares. Yeah, that offer a zillion different ETFs. So it says BlackRock is adding Bitcoin futures as an eligible investment to 2 funds. The first time the money manager is offering clients exposure to cryptocurrency. It says the world's largest asset manager filed updated prospectuses for a pair of funds, including cash-settled Bitcoin futures, among assets they're permitted to buy. The filings for BlackRock Strategic Income Opportunities and BlackRock Global Allocation Fund appeared on the US Securities and Exchange Commission website on Wednesday. Derivatives using cash settlement do not require delivery of the underlying asset. So it's kind of a little bit of a workaround, I guess, just using these futures. So it's a derivative as opposed to actually owning Bitcoin. But it's interesting that they kind of, BlackRock are making this decision. This is the first little decision where they're allowing Bitcoin to kind of creep into their investment products, which is weird because I think it was one of the top dogs at BlackRock last year did some interview and he said, look, we don't believe that any of our customers are interested in Bitcoin being a part of our investment products because they're so focused on, whatever it might be, stocks or bonds or whatever. But now they, I guess it looks like they're kind of backtracking a little bit. It says here a BlackRock spokesperson declined to comment beyond the filings, but it says here Rick Ryder, BlackRock's chief investment officer for global fixed income, said in a Bloomberg television interview last year that there's a clear demand for Bitcoin and that it is going to be a part of the asset suite for investors for a long time. So a little bit conflicting there, but this is obviously the first... I guess this kind of opens the door, doesn't it?
Yeah.
And I'm surprised. Well, I guess maybe they could make a cryptocurrency related investment product, and that would probably be quite popular. But yeah, certainly opening the door. BlackRock seems to be opening the door for Bitcoin.
Yeah, I mean, it's funny that they do this now after Bitcoin's gone up so much. It's just, to me, it's just so backwards that these things now there's the demand for it after the price has exploded so much. Obviously that's how markets function, but it's just like if Bitcoin really is that valuable, the people should have been buying it up last year for a fraction of the price that it was, but people weren't because nobody knows what it's worth. People are only interested now because it's gone up. Just crazy.
The original story for Bitcoin was Bitcoin's stupid and worthless, and then it started gaining traction. Then the story was Bitcoin's the next big thing, it's the future of currency. Then it crashed and the story was Bitcoin's worthless, and now that we're back where we are, the story is Bitcoin's the future again. I mean, the story just changes because no one knows what it's worth. No one knows the implications for the future with this technology. Yeah. So the story literally just changes depending on what is happening with the price.
It's amazing. Yeah. It's amazing.
Yeah. It's kind of like, it makes me think, well, okay, instead of Bitcoin, imagine Bitcoin in this story, or over the past, 5 years, Bitcoin was instead replaced with 1970s baseball cards. It's just like baseball cards, they're printed on a piece of cardboard. They're not actually worth anything beyond what a little piece of cardboard is worth, which is nothing. Obviously, the value is whatever people assign to the baseball card at any given time. It's like, what if 1970s baseball cards over the past 5 years went up like 100x? Then would BlackRock be saying it's now adding baseball card futures to its fund? It's like, it's the same situation, but I mean, that example obviously just makes it seem a little bit crazier. But I mean, it's the same situation, something that doesn't really have any underlying intrinsic value. And just because it's gained popularity, all of a sudden people are like, oh my God.
So strange.
It's very strange.
Yeah, I honestly, I don't know what else to say for like Bitcoin stories anymore.
Yeah, I think we've said our piece, haven't we, multiple times?
Yeah, it's just, we'll see what happens. It's currently, I was just looking at the price, sitting at 46,000 Australian dollars. So just off the high, I think the highest it got to was just over 52,000 per Bitcoin. Yeah. So it is down like 6% or so, but basically it's still right up near its all-time highs. So we'll see what happens. Whether it's going to pop in just either
bizarre
direction.
I mean, I have to think that it's going to just get destroyed. When I look at that chart, just my heart of hearts just says, oh dear, that thing is coming. It's like when I look at Tesla stock now. Like, I love Tesla and I'm a Tesla shareholder. Yeah. But when I look at that thing, the first reaction that I have is, oh my gosh, that thing is coming down.
Yeah. But the thing with like Tesla, for example, the reason why you look at the chart and you go, oh my God, it's so overvalued, is because you can compare it to the underlying business, right? Like you can look at the business and say they're growing well, but they're not growing that well. Whereas like you look at a long-term chart for say, I don't know, Apple, for example, it looks the same, but you don't, it's not as if Apple's a bubble because the business has grown exponentially over that period. Whereas with Bitcoin, there's nothing to compare it to. There's nothing you can't look at the chart and to me at least, you can't look at the chart and suggest that anything, that it's overvalued or undervalued because there's nothing to compare it to.
So what's the intrinsic value of one Bitcoin? Who knows?
Yeah. Who knows what's going to happen?
There's no way of telling. Yeah. No, I agree. But anyway, interesting. Yeah, BlackRock obviously opening the door to Bitcoin. So, I mean, is it just a matter of time before it starts to work its way into a lot more of BlackRock's investing products? Who knows? We'll have to watch this space. But it's always that first step that's the hardest. And after that, it becomes easier and easier. So we'll see what happens with BlackRock in the future. All right, what do we got next?
Let's do this earnings story. Netflix.
Yeah, let's talk Netflix.
Q4 and their full year earnings were released this morning or yesterday, I think. So this is the first company we're actually looking at this earnings season, which we'll probably have a number of companies that we'll look at over the next couple of weeks. So if you have any that you want us to cover, then make sure you head over to the YouTube version of the podcast, youtube.com/The Young Investors Podcast, and leave your questions as comments on the latest video. And or questions or companies for us to take a look at.
But generally speaking, some of the bigger companies, like if you've got one of the bigger companies you're looking at, because I don't think like we're not going to be looking at, some small gold
Signal?
mining stock. Yeah, something like that. Or Signal might get a mention now because of all the hype around Elon Musk.
It actually might. No, but big companies like, if you have any sort of in the top, 100 or 50 biggest businesses in the US or Australia, then we'll likely be looking in that realm to keep it relevant for as many people as possible. But
exactly,
we can certainly take suggestions on board.
All right, Netflix, hit me up, Hamish.
Right, so there's a couple of major numbers to look at for Netflix. The first is, of course, how many subscribers they hit. In the fourth quarter, they passed 200 million paying subscribers. Wow. So a huge milestone for Netflix. They gained 37 million subscribers in the last year.
That's insane. That number, that is insane.
It's a lot of people. Yeah.
37 million. I remember, what was it? The quarter where they had 12 million ads or something like that. That was just insane. Sorry.
Yeah, ridiculous. So that's a 22% yearly increase in the number of subscribers. And 200 million is just insane because it's a lot of people paying subscribers. Yeah. This isn't just active free users on Facebook or TikTok or something. This is people who are paying $10 to $15 a month. So that's very impressive. Revenue hit $24 billion for the year. That was an increase of 24% year over year.
It's good growth.
So basically 22% of their revenue growth. So they had 24% growth. Of that, 22 came from more subscribers, and the remaining 2% would have been a combination of price increases, very slight price increases, and maybe some foreign exchange in there as well, because they're receiving money in a number of different currencies.
Very interesting.
Yeah, in terms of operating profit, they reported $4.6 billion in profit, which was up 76% year over year. So huge increase in their profits. But
that would have been a result of firstly heaps of subscribers jumping on board because of the lockdown, but also I would have imagined they'd have much less operating expenses because they didn't really do anything in the last year, right?
Yeah, I mean, they certainly made a lot less movies. So we'll see that impact would be felt on their operating profit, but also on their free cash flow, which we'll talk about in a little bit, how much cash the business outlaid. But one of the other things that Netflix likes to talk about is their specific Netflix movies and TV series that were released throughout the year and how they performed. And they had some very high performing TV shows and movies. So The Crown, it's a TV series, had 100 million households watch it. Since it was released. Sorry, that's for season 4, which is
is that the latest season?
That is the latest season that was released this year.
Wow.
So actually, I believe that figure is probably the total number of people who have watched it from any of the seasons. Okay. But the season 4 was released in 2020, which is why they're talking about it. The Midnight Sky, which is a movie, has George Clooney in it. 72 million households watched it. The Queen's Gambit, 62 million viewers, households in the first 28 days. Have you seen that? Queen's Gambit?
I've had it recommended to me by a lot of people, but I've not yet watched it.
Very good.
What is it about? Isn't it about chess or something?
Yeah, so she's like a young chess prodigy, and then she becomes very, very good.
So you've seen it, have you?
Yeah, it's very good. And now I'm addicted to chess. I can't stop playing chess.
You know, sometimes I get recommended on YouTube, what's his name? Magnus Carlsen or something.
Yeah.
Him like playing some fool in chess, and he's like online. He'll play someone online, and he's just like, "Oh, that's very interesting." E9. That's not the right move in this situation because you'd actually take C2 and blah 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 blah. He's like the rate at which his brain is moving at when he's playing chess is just insane, and he's just saying like and he knows the entire board like as A, B, C, D, E, F, G, H, and then 1, 2, 3, 4, 5, and so on, and he just knows exactly like where it's like he's at war. He's like he's war strategy or something. He's moving this here and that there, and he's thinking 2 steps ahead, covering this and stopping that. It's flipping insane. No, I certainly have a lot of respect for people that can play chess at a very high level because, man, that's the strategy and that is insane.
Yeah, it's ridiculous. It's really interesting, the whole chess, the whole world of chess, because they don't make very much money, the really top players. So a lot of them stream on Twitch or on YouTube. Magnus Carlsen's the number 1 rated player in the world at the moment. So, and he streams on he posts videos on YouTube. I don't think he streams on Twitch, but there are others that do. Very interesting. There's a lot of some of the favorite videos I like to watch are ones where they play blindfolded against people and they just call out the moves that they're making.
Really?
Which is, wow. And they'll have someone else call out what the other person's move was so that they know because they can't see the board.
And then they've just got to remember.
And it's just insane. I don't know how people do that.
Wow.
But Queen's Gambit, very good show. That's my little tidbit from this Netflix segment.
Cool.
Go watch it.
I'll give it a watch tonight.
Yeah. So in terms of other sort of achievements that they mentioned, so they have this list of Google's searches from 2020, and one of the ones that they focus on are the top searched TV shows and then the top searched movies on Google in 2020. And out of the top 10, 9 of them in 2020 were Netflix originals, which is kind of insane, right?
Yeah. That sounds like a bit of a wishy-washy stat to put in an earnings report, but I actually think that's a pretty valid statistic and actually quite impressive. If you think about how many people are Google searching for TV shows, 9 out of the top 10 that were searched on Google were Netflix originals. I actually think that's quite telling, and it's pretty good credit to Netflix to be able to do that. And I think that I know I'm going to spoil your next line that they rate 2 out of 10 for movies. But I actually don't mind seeing that because I think where it's at for Netflix is definitely TV shows, because you got to keep – I mean, TV shows just work for the idea of a subscription model media service like Netflix because you've got to keep people coming back. You have to have a reason for people to continue to pay for that subscription. Yeah. I mean, once you've watched a movie, unless it's like a big saga or whatever like Star Wars and you've got like however many movies to watch, once you watch a movie, then you've watched it. But if you're really hooked on the Crown or on Queen's Gambit or whatever, you want to show up and see the next season, so you keep paying for that subscription. So I actually think that's a really good strategy, and it seems to be working very well for Netflix.
Yeah, definitely. It is a bit of a stat that, I mean, it's not like you're going to use that stat to do any kind of projections or anything, but it is fascinating to use Google as a kind of a guide on what people are searching for and how Netflix is ranking, because of course
for a general trend, I'd say that's quite promising.
Yeah, because of course big movie studios typically use box office record numbers, right? But Netflix doesn't have any box office numbers to report.
Yeah, exactly. Yeah.
So they have their kind of how many people are watching these series, and then I guess they use how many people are searching for certain series as well as an indicator. I wonder if the number of watches or household watches I think they use, I wonder if that's going to be like a standard. I presume it will be. It'll be more of a standard than box office going forward, because box office is historically like the metric that you use to indicate whether a movie has done well. How much sales it did at box office in the first day, in the first weekend when it premiered. But now if there's a lot more content coming out on streaming services, then there's much more emphasis on how many people watch it in the first month or watch it in the first week or whatever. So
True. Yeah.
Very interesting.
No, that's right.
In terms of debt and cash flow, always fun to look at Netflix's debt pile and see how high it is.
Yeah, it's been the story we've been following over the last couple of years, hasn't it?
Yeah, it has. So they had a few things to say. First of all, free cash flow was $1.9 billion in 2020, which is quite impressive. But of course, that was, as you mentioned earlier, due to the fact that they had very limited production in 2020. And as a result, I think I mentioned this a couple of quarters ago when we were talking about their earnings, but the number of releases that they had for the first quarter in 2021 was supposed to be lower than normal because, of course, they need to produce them in the previous year. And that's kind of what happened in 2020. But in terms of what management thinks, they expect that they're going to be back to break even in cash flow in 2021, and that's due to normal production resuming in 2021 for the full year. So that will mean that they'll be at break even, which is actually an achievement for them because excluding the abnormality of the pandemic, they were heavily negative in a normal production year. So the fact that they're break even is really positive. It's not really that they're going from positive to break even. It's really that they're going from negative to break even if we exclude the fact that the pandemic messed everything around.
Yeah, under normal conditions, they're trending now in the right direction.
Exactly.
Which is what they really needed to do. Because, yeah, you're right. You look at the free cash flow over the past however many years and it's just negative. So, yeah, then they've always been talking about this plan to be, break even and then free cash flow positive going forward. So it's I hope that comes to fruition.
Definitely. And then in terms of debt, so they have currently $15.8 billion in long-term debt, which was up about $1 billion from last quarter, I believe it was. So a slight increase in long-term debt, but management believes that they don't expect to take on any additional debt for their normal operations in 2021 and beyond. So they think they're done.
So what's normal operations? Does that include all of their creation of TV shows and movies and that sort of stuff?
Yes, I believe so. Yeah. So
it doesn't just mean our normal office operations or anything like that.
No, I
don't know. You'd imagine it would mean everything.
That was my interpretation, that it meant that they can operate normally without losing money now that they're break even, and they will no longer be losing cash flow in a certain year after all of their movie productions. And as a result, they don't need to take on additional debt to cover those losses.
So maybe they've got everything set up now. Maybe there was a lot of production. Maybe there was a lot of costs in setting up production facilities and whatnot. Maybe that's all done now. But I don't know. I'm a little bit skeptical when I read that.
Yeah, well, I mean, yeah, of course, take it with a grain of salt. The other thing is also there would be a point, and maybe they've achieved that now, where they have enough subscribers that it can cover the level of production that they've been previously doing. So maybe they're at that point, or if they want to increase production in the future, they know that they can have a little bit of wiggle room with price increases and other things. So that could be the situation. But yeah, of course, well, only time will tell whether they actually need to take on additional debt. But they currently have $8.2 billion in cash, so they have quite a lot of a cash buffer if they did actually want to increase production and be a little bit less than break even, for example, in 2021. But management said something interesting. So first of all, they have $500 million of short-term debt on top of the $16 billion in long-term debt. So short-term debt, if you see that in the current liability segment, that basically is all the debts that are due in the next 12 months. So that's how you can read the balance sheet for people who are unaware. And long-term debt is beyond 12 months. So they have $500 million due in the next 12 months, and management actually said that it's due in the first quarter. So that's getting paid down. And the other interesting thing that they said was that they plan to maintain 10 to 15 billion in long-term debt. So, and instead of using the excess cash to pay down debt lower than that, they're going to use excess cash to do share repurchases. So they're happy to have 10 to 15 billion of debt on their books. And then as they get positive, as they pass break even and they start being free cash flow positive, instead of using that money to reduce the risk of the business and reduce the debts, they think that amount of debt is safe, manageable, And as a result, they are going to use excess cash to do share repurchases.
Man, I don't like that.
I don't like it either. But I don't know.
Don't like that.
Look, I have mixed feelings. Yeah, you give your thoughts and then I'll share mine.
I was just going to say my general rule of thumb is I like a business that can use its free cash flow and if they had 3 years of that free cash flow, then they could pay off all of their debts. 3 to 4 years of free cash flow. I know that's a general rule of thumb. Yep. Well, where I learned it was Phil Town. I think he mentions that in his book. When you look at free cash flow, that's the amount of money the business is generating that can be used for whatever after capital expenditure. So it's like, okay, well, if you got 3 years, that's a general rule of thumb, pay back all your debts. Whereas even if they were able to make $2 billion in free cash flow going forward, every single year going forward, $6 billion. That's what I would like to set maximum in debt. And they've got, over double that. So I don't know. And like so annoying. It's like share buybacks. Yes, your existing shareholders benefit, but at the same time, you're leaving this big question mark over the financial security of your company. Yeah. And as a long-term shareholder, the first thing, this is Warren Buffett's first rule of investing: don't lose money. I want to, as an investor, I put myself in situations where I'm likely going to make money, but first and foremost, it's not likely that I'm going to lose money. Yeah. So don't worry about the share buybacks. Just build up the walls of the castle. Like, make sure it's a financial fortress and get rid of that debt. Because that debt's just leaving the door open for bankruptcy to creep forward. If something bad happens, then all of a sudden they go, oh crap, turns out $16 billion of debt wasn't safe. And then they're business is up in smoke. Yeah. So I don't know.
Yeah, I think you should always assume that there could be some unforeseen event that causes the business to lose money for a couple of years, that they go unprofitable for a couple of years and as a result may have trouble paying down the debt when it's due or refinancing it. Because that's the other thing, right? All these companies bank on the fact that, one, that they stay profitable, but it's not really that they plan on, it's not as if Netflix has this $15 billion in debt and they plan on paying it down over the next 10 years. They're just planning on keeping $15 billion in debt, which means that when the debt comes due, say in 3 years or 5 years or whenever it is, they're going to get a new loan, they're going to refinance and pay off the old loan. But the bet is that they have the ability to do that. And there's been times where businesses have not been able to do that. 2008 is a great example. There was a huge credit freeze where businesses couldn't refinance. Banks were so panicked about their own books that they were not offering more loans to a lot of businesses. So I think you're right. I think it makes a lot more sense from someone who, if you don't want to lose money at all, if you want to just eliminate that risk, it would make more sense for the business to reduce that debt. And that means that they're going to return less capital to you, right? I think that's pretty straightforward to understand. If a business takes on more debt, they have more capital. They have more money that they could return to you in the form of share buybacks, but the balance of that is obviously an increase in risk. So more returns for Netflix shareholders in the short term, and that comes with a slightly higher or a higher risk of it completely destroying the business at some point. Or maybe it doesn't.
Good comparison is like what happened in 2020 with the airlines. They copped so much scrutiny because instead of bolstering their balance sheets, on the off chance that something horrific would happen, they just decided to, chances are nothing bad's going to happen. Nothing big and bad's going to happen that'll really impact us. And instead we'll just do these massive share buybacks. Oops, 2020 global pandemic, something really bad did happen and now we've got no money. So, that's what can happen when instead of, building up a financial fortress, you just decide to do buybacks instead and just leave the door open for bankruptcy. It's like tempting fate, isn't it? It's nothing bad's gonna happen. As soon as you say that, you know something bad's gonna happen, right?
Yeah.
It's just tempting fate.
There's a very good quote from Peter Lynch I really like. He says that if a company doesn't have any debt, it's very hard for them to go bankrupt. And then he says something funny like some of them try to, but it's very hard for them to go bankrupt if you don't have debt.
Yeah, it's true because you don't owe anything to anyone.
Yeah, I mean, you certainly don't owe any debt at least. You might owe other people, but it's very, very hard if a business has no debt to go bankrupt. So that's the best kind of investment to have.
Talking about a business that would be very, very difficult to go bankrupt, Facebook. What you got to talk about with Facebook?
Yes, so we've got some little bit of an update. It's a bit of a non-story, but basically the head of Facebook Australia made a blog post and sort of is urging the Australian government to change their news media bargaining code, which is slowly but surely getting pushed through.
God damn it!
And I'll talk a little bit about what the legislation does, but it's basically getting closer to pushing through. It was introduced into the House of Representatives last year, I believe, mid last year, and they're currently going through some. It's kind of like a research phase before the Senate decides if there's any changes, and then they can vote on it, and basically it's moving forward. So what the article say here? Last year, the government initiated new legislation that would essentially compel Google and Facebook to pay media companies for news published on their pages. And the head of Facebook Australia released a blog post today. Says the news story is his thoughts on it. He said, and this is a quote, "There's no other law like this in Australia. No other business is forced into a highly uncertain binding arbitration process where the government decides who enters these agreements and forces the payment from the provider of a free service."
Yeah, it's crazy.
Which is, when you say it like that, it just sounds insane.
It does sound insane, doesn't it? You must pay us. Yeah, that's crazy.
Yeah, so he's basically arguing that the legislation seems to suggest that Facebook is stealing business from news companies. So that's the whole idea of this, is that because of previews on Google News and on Google Search and on Facebook, that these companies, Facebook and Google, are in some way stealing business away from the media companies. Because, of course, if you read the preview on Google News, you don't go to The Age's website. You don't get asked by The Age to pay $1 or whatever it is for their article, and you don't get to see their ads where they make ad revenue. So that's the argument, is that they're basically stealing business by using their articles and previewing their articles for free, when, this is my opinion, of course, in reality, the way I see it is that the loss in revenue from the previews is substantially outweighed by the traffic that Facebook and Google drive to their sites. So
exactly,
the head of Facebook Australia basically said that they estimate that last year Facebook provided $400 million worth of free clicks to news outlet sites, because, of course, they can see how many people click off Facebook onto these news sites. And they can also calculate how much those clicks would have cost if they spent on paid advertising on Facebook or Google. $400 million. Facebook provided them.
Yep. And in all honesty, this is an area where I'm actually like, I kind of hope that the big US companies like Google and Facebook just smack the Australian government silly. I mean, usually I'd be on the other side. I'd be like, yeah, let's, go to Australia, stand up and take down these big companies. But this time around, the news media bargaining code is just an absolute, in my opinion, it's an absolute pile of nonsense.
Yeah, I mean, it is so blatantly a policy that's being pushed through by donors to the current government. It's
news
so blatantly. It does not. It singles out news companies that are traditional news companies, not because how many small independent news companies are there now? None of those companies are involved in this. It's News Corp and a couple of other
it's the big dogs.
It's just the big dogs that have lost a lot of revenue because believe it or not, you can get a lot of things that they used to provide for free on the internet now.
It's just unbelievable, isn't it? It's almost like the big news companies that own magazines, they're actually losing business in this modern age that they failed to keep up with.
Yeah.
It's almost like the free market is driving them bankrupt because they've got a shittier business.
Yeah, something that I found really interesting was that a lot of the revenue loss that traditional newspapers and such have lost, newspapers in particular, a lot of the loss actually isn't from just the advertising you would think of. It was advertising specifically in the jobs section of the newspaper, where because people used to look in the newspapers pretty much universally for jobs. But now, of course, you can look for jobs for free online. And that's actually where a significant amount of the revenue for those companies has been drawn away.
Interesting.
And there's just a lot of things you just don't need a newspaper for anymore. Like it used to be where you would go to see the weather or, as I mentioned, to look for jobs. There was things that were universal that you could only access in those places. And the internet has just opened it up to everybody else. So the real monopoly that has been extinguished has come from the media companies who are now pushing this legislation, which is hilarious to me.
It's like, all right, we're losing, so we better try and lobby and change the rules.
Yeah, we lost our monopoly. So what should we do? Let's say that Facebook's a monopoly and take their and take even more money from them. And the amazing thing is, I've clearly got I've got a bit of a stake in this argument. Obviously, I'm invested in Facebook. Yeah,
me too.
Just to be completely transparent, but. Oh man! But a question a lot of people might ask, and I had this question was, well, if Facebook and Google are just providing so much value to these news companies and this deal is so bad, why don't they just stop showing news? Like, why doesn't Google just say, okay, News Corp, well, if you're not going to basically appreciate the fact that we send you hundreds of millions of dollars worth of links, link clicks and traffic, we could just remove you and then we'll see how that goes for you.
Suffer.
and yeah, I mean, basically the legislation prevents them from doing that. So not only does the legislation, Google and Facebook are essentially compelled to provide millions of dollars worth of free traffic. And then on top of that, Google is the government is forcing them to pay even more for previews on their site, which is just ridiculous. It is the most.
The legislation wants to, at least when I was following this back when it first popped up, maybe it's changed since then, but it wants to provide news outlets essentially the way that these algorithms work so that so that the news sites can always show up as a priority over everybody else's content.
Yeah, they want to be told when there's changes to the algorithm, which is just absurd because Google had 3,000 changes to their algorithm last year, which means that they can't do that many. I think they needed 28 days notice or something before they make the change, which basically means Google could now only do 12 changes a year compared to the 3,000 that they typically do, all these little small optimizations that make the platform better over time and that make recommendations so good to the point where you just type like 3 letters now and it like somehow knows what you were thinking. It's kind of scary, but you're like thinking Japanese food in this suburb and you just type J and it's like there. It's like, what the hell? Okay, how did you know?
Yeah. No, it's crazy. But that's the thing that really gets me annoyed about this is that they're just being handed the keys essentially. Because that's why I like, Facebook and Google and YouTube. It's like on YouTube, not the only people that really know the ins and outs of the YouTube algorithm are the people at YouTube, the ones that are making the algorithm. The rest of us, it's just nobody really knows. So it's like if we make the best content, if we make content that we've put so much time and effort in and it's just better content than the next person, then through the algorithm, we will do better. Yeah. So it's like, and that's the thing, all of these news sites, they get like no views whatsoever. And it's like, it's almost as though other people, creators like you and me and various other people around the world, we're making better stuff than you. And that's why you fail.
Yeah, there's no conspiracy by Google to push news down in the rankings.
Exactly.
your content
Yeah.
just isn't that interesting.
It's just
not
your
that
content
good.
sucks. Just make something better.
Yeah, believe it or not.
If you made better content, then more people would click and then you wouldn't have a problem.
Yeah, I mean, believe it or not, people's preference for how they consume information can change. And a lot of people like hearing it from someone that is much more relatable.
Yeah.
That's just the reality of what's happened.
and honest.
that might
Relatable and
relatable
honest.
and honest. And that might, and the fact that you can get 5-minute takes from 100 different people if you wanted to.
Yeah.
You don't have to just sit in front of the same 2 people who have been telling you the same thing for the last 50 years. You can get a range of different views. So it's just more spread. The ad revenue has basically just been spread out. It used to be very controlled by a number of, it basically was a monopoly, which is hilarious because that's what the legislation is trying to, it says that it's trying to prevent, is like to stop these monopolistic companies like Google and Facebook, when in reality, they've stopped the monopoly on media, which is...
Yeah, the monopolistic companies have stopped the monopoly of media.
Like,
Exactly right.
It's just amazing to me. But it is what it is. We'll see what happens. It's going to be very interesting. Fortunately for us personally, YouTube is kept out of all of this. So it is.
Oh, thank God.
So we're not going to be... I was quite worried.
I was
honestly.
worried as well.
When I first heard this, it made me a little bit sick because, I was just worried that basically news... like traditional news on YouTube would have been pushed far higher than my content, particularly because our demos would be pretty similar for news and politics and investing.
When it first came out, it sounded like we were going to lose our YouTube, not our YouTube channels. We were going to lose the YouTube, experience that we all
know.
log into and know and love and use every day. It felt like that was going to drastically change. So that's good.
But Google, I mean, if they can only make 12 changes a year because they've got to give alerts to the news companies, then
dumbest thing I've ever heard.
Basically Google will not improve at the same rate in our country as it will in other countries. And that's pretty sad to me.
That's just not good. That's just not good for us. Yeah. Anyway, not good for us, not just talking about me and you, but not good for us as Australians collectively that like to use this platform.
Yeah.
Even just to watch videos. Anyway, we spoke a lot about that, and now we're completely out of time. Should we do maybe like 1 or 2 Q&As?
Yeah, sure.
And then we'll scoot out of here. Okay, well, let's go for this one. Hey guys, always appreciate your work and content. Thank you very much.
Thank you.
I have a question regarding the discounted cash flow model. How would you adjust your DCF model for a company that has had a significant downfall in its earnings and cash flows in 2020 due to COVID-19? I was wondering whether you would use EPS or owner's earnings during the pre-pandemic time, or still use smaller numbers with the pandemic effect. Also, would your growth rate over the next 10 years be adjusted accordingly? Hamish, what's your thoughts?
Yeah.
We're talking a little bit about this before.
Yeah, we were before we jumped on. There's a number of ways you can go about this. I'll leave your way, Brandon, and you can explain that. I won't take that from you. But there's a few ways. The main way that I go about projecting discounted cash flow is I'll usually come up with a projection about the business in 10 years and work backwards to get the growth rate. So say, for example, it's a retail company. I would make a projection about their online sales, about how many stores they're going to build, are the sales going to increase or decrease at those stores, and come up with, and then, profit margins, and then come up with basically a picture of their cash flows in 10 years. And then I will just do a calculation from the first year to the 10th year to figure out what the growth rate would be. So if we were working from a really low number from the pandemic, then that growth rate would just be really high to grow up to that 10-year number. That's one way you can do it. But if it kind of depends on the circumstance, I think. If the business's numbers have just gone down slightly, so there's just been a moderate impact, then that kind of works. But if the numbers have been just completely destroyed and you expect them to come back immediately or fairly quickly in the next year, then you could use last year's number and just have a slower growth rate over a 10-year period. You could take a 10-year or a 5-year average from the past to capture a bit of an average. Those are some of the ways that you can kind of go about it.
The other way we were talking about as well is you've got, generally speaking, with your discounted cash flow, you're going to take your cash flow, you're going to figure out a growth rate that you think they can grow for in the next 10 years, and then you apply that, grow it out over 10 years. But obviously, if we've had this one-off event that's a short-term event that's, dragged their business down substantially, however, through your research, you think it's going to just bounce back, maybe not this year, but maybe next year or the year after that, you can just, instead of just going, okay, I've got my free cash flow or my owner's earnings, and I'm going to model it out for 10 years based on this specific growth rate that I've come to a conclusion on, you can just model it out year by year. So you can say, okay, 2021, and this is just an example, just based on nothing. 2021, they're going to bounce back. I've done my research, and I think that, based on these factors, I think they can bounce back by, probably 50% in 2021. Mm-hmm. Then in 2022, they'll probably bounce back another 30%. And then after that, then they should be close to, whatever, back to normal. And then after that, the long-term growth rate I think this business can manage is like, 15% a year or something like that. So you can manually grow, okay, they're going to bounce back 50, then 30, then 15%, 15%, 15%. Mm-hmm. And you can model that manually to try and get you through your discounted cash flow. Because there's a problem obviously in that, the pandemic might have dragged a business down very substantially, but if it's a great business and you have a strong feeling that it's going to bounce back and then be better than ever in the future, then obviously that's a problem because otherwise it's just like, oh, is this business is starting from now where it was 15 years ago, which is obviously not going to be the case. But yeah. That's just another way you can do it.
It will entirely depend on the business because you have some businesses have been just severely damaged by the pandemic and they'll take a long time to come back. Businesses that would fall into this camp would be businesses that had to raise a lot of shares, had to take on a lot of debt. Those are higher expenses that are going to be there for quite a long time. Whereas you might have other businesses where their numbers were just artificially down for a year because of some particular restriction, but those numbers may be expected to bounce back quite dramatically to normal levels or near normal levels quite quickly. I'm trying to think of an example of a business like that.
I don't know, but something where maybe like a gym, for example, like this, there's probably no publicly traded gyms, but there was a period of time in Australia where gyms were forced to close. Like gyms, you are not allowed to run your gym, okay? And that was just based on a law, which is now no longer in place and gyms are open and whatever. So, that might be a case where, okay, really our business our business doesn't suck. We've just been stopped. And, generally we might not be back to 100%, but when that law goes away, then we should return back to almost normal functions again. Yeah. Something like that. I don't know if that's the best example, but it's just one that I thought of.
Pretty good.
All right, we should wrap things up there. We've been going for long enough. We'll make an effort to do more Q&A next week. But thank you guys very much for sending in your Q&A questions. We've got 1, 2, 3, 4, 5, 5 questions to get through already next week. So, but keep them coming. Like we always like that constant flow and what you guys are thinking about and your perspectives and questions on, current events or stuff that just about investing. So definitely keep sending in your stuff and we'll keep running through Q&A. Mm-hmm. Man, we really just got caught up on that news media bargaining code.
Yeah, we talked about it for way too long.
We just went crazy. I think it's because it hits close to home with us and what we do on the internet, but we didn't even get to the Bumble news story, but there you go. Bumble's going public. What do you know?
Yeah, who cares?
we can cover that one next week. But no, thank you guys very much for listening and sticking through and giving us an hour of your time each and every week. We very much appreciate it. Yes. Thanks always, Hamish, for joining me for the hour of stock market chatter each week.
Thank you.
And thanks always to ShareSite for sponsoring. And that will do us for this week, guys. Thank you very much for listening, and we'll see you guys next week.
See you guys.